Bruce, do you think the dollar continues to climb higher? How much so?
It's remarkable to see. Hi, Sarah. It's remarkable to see this 20-year high in the dollar, and it's versus the euros versus the basket of other currencies as well. So let's start with the euro. It's not only a weaker GDP and the weakness in the energy markets, or the weak ability for Europeans to procure energy, but it's also the fragmentation that we're seeing in Europe. And you see that through Italian bonds, Italian spreads, as well as other peripheral spreads. And in general, Europeans are becoming more risk adverse. And so what you're seeing in Europe, you're also seeing at the Bank of Japan. And as it relates to the yen, it's a 20-year plus weakness there as well, because they've capped rates in Europe, and people are bailing out of euro assets and Japanese assets and coming to our markets to buy our treasuries and our U.S. dollar. And so the Fed has a more complex, equation here, because our treasury rates have not moved up as much as they probably should have. I think it also speaks to the weakness in crypto assets, why our dollar is stronger.
Do you see all this continuing?
I do, and I think the dollar strength will continue to keep our rates lower than it probably otherwise should be. To your point, I think that U.S. companies, which rely on S&P 500, for instance, relies on 25% of its revenues from overseas sales. We'll see it continued softening in their international sales and their global revenues. So I think the trend is well in place. Look, the Fed has only gone from 0 to 1.75 today, where it is now in terms of Fed funds, on its way to 3.5%. So only halfway there. And so if you're going to continue with this trend of much higher rates here in the States, with higher, treasury rates and supportive action by our central bank vis-a-vis other central banks, you're going to continue to see the flow of capital come into our currency.
So, Bruce, you have been early in the recession bet, and I believe recently told your investors that is the base case scenario right now when it comes to your underwriting of deals. So what are you expecting at this point? When and how severe of a recession?
Well, we think the recession begins sometime in the first half of next year, and we think the European recession starts in the second half of this year, either this quarter or the fourth quarter. In terms of, S&P earnings, for instance, we think we're already moving towards a earnings recession. So here's a fact for you. Just before coming on the call, I went back and looked at the last 4 recessions, and earnings have dropped. S&P 500 earnings have dropped between 20 and 30% in each one of the last 4 recessions. And so companies are getting squeezed on all sides. You're getting squeezed on the cost of goods and the wages and all things that go into input for not only manufacturing, but also services. And on the other end, we think revenues are starting to flatten before turning down at a time when interest cost is going up, particularly for the high yield companies. Interest charges are rather significant. There's more leveraged loans in the system than there are fixed rate high yield bonds. And when you look at Fed funds up or SOFR or LIBOR up 300 basis points from where we started to where we're going to be at year end, that's a lot of downgrades and a lot of potential defaults coming through the system as a result of higher charges.